Okay, I see that we're at the top of the hour, so I want to welcome everyone to the 10th webinar in BALLE's Accelerating Community Capital series. My name is Alyssa Barron, and I serve as the co-managing director at BALLE. We're delighted to have you all with us today. We have 108 people from almost as many communities signed up to join us today live, or in a couple of cases through our archived materials from across North America. So I'm going to review a bit of housekeeping, provide a few reminders about our webinar series, and then introduce our topic and speaker for today. So if you're dialed in by phone, but you've not yet joined us in the webinar room, please find a link in your reminder email from Ali Walker on the BALLE staff. Because of the number of call participants, we have the phone line muted. So if you have a question for Dan, our presenter, at any time during the webinar, you can type that question in the public chat window. Dan will not be able to see the chat window because of how he's presenting today. So feel free to ask questions as he presents. I will catalog those as moderator, and then when we get to the time set aside for Q&A, we will serve up any questions that have already been asked, as well as all that come during that Q&A period. If you have any technical difficulties during the webinar, you can note that in the chat window, and then our staff member, Ali Walker, will contact you to assist you. So you'll see in the right-hand side of your screen this chat window that says public. There's also a second tab that says private. To the right of that tab, you will see a third tab show up in flash red, and that's how you'll know that your tech assistance request has been answered and will be taken care of by Ali with you in private. You can also chat with other webinar attendees that way if you like. After each webinar, we email everyone registered a link to a recording of the webinar, that's the audio and the visuals, as well as a PDF of the presentation material itself and a copy of the questions in the public chat window. So we get that email out within 48 hours of each webinar. So after the webinar closes, watch for communication from Ali Walker on our staff with access to the archived materials. So some reminders about our series. These community capital webinars are held the first Tuesday of every month at this time, 10 a.m. Pacific, 1 p.m. Eastern. The series runs from February through December 2011 and is co-hosted by RSF Social Finance and Slow Money, and additional series partners, the Association for Enterprise Opportunity, or AEO, Portfolio 21 Investments, and Investors Circle. The series is explicitly focused on tools you can take home and try out right away. So every month we feature a case study with a community capital innovator. That is somebody who's developed and piloted a working model for connecting local people's investments and businesses and farms to regional needs using regional resources. The innovators present their model, and we always allow time for dialogue and questions. So we suggest that communities treat these calls as an opportunity to bring together a group of business owners, social entrepreneurs, lenders, philanthropists, investors, anyone in your community who is interested in the topic. And after listening to the webinar, you might spend an hour discussing with the group the applicability and relevancy to your community. You don't have to pay extra per attendee on the same webinar line. So of course we welcome individuals participating, but we encourage everybody to take a networked approach to really get full value. So our final webinar in this year's series will be the first Tuesday of December. We'll be announcing that topic here in a couple of days. And we also will be extending this series, including another day-long workshop before our annual conference into 2012. So stay tuned for news about our December topic, as well as the early speakers in the 2012 series. We're very excited to continue this work with our series partners. So I want to talk a little bit about Daniel Fireside, Equal Exchange's Capital Coordinator, who's with us today. We're very excited to have you with us, Dan. Equal Exchange has created a CD, a targeted CD, as a way of furthering their mission. And we think that this is an approach that's very replicable in BALLE networks and Slow Money chapters and all of the folks who are joining these webinars in your community. So Unfortunately, as with most conventional investment vehicles, the money invested in a traditional CD is used to generate the greatest profit for the host financial institution, regardless of social and environmental consequences. Equal exchanges CD means money invested in the CD goes to support equal exchange, fair trade, and all of the small farmer partners that they support through their work. And so we're really looking forward to hearing from you, Dan, today, how you set up this CD, how it works, who you're serving with the CD, and some thoughts about best practices and replicability for other communities. So with that, I am going to turn it over to you to pull up the screen share of your slides. So we'll give you a moment to get that pulled up. And there you go. I see it right now. So take it away and feel free to say anything additional about yourself or your background if you would like.
Okay. Well, thank you all for attending, and thanks to Alyssa and everyone for the opportunity. I've been at Equal Exchange for a couple of years. Hopefully many of you have heard of us. And I have the funny title of Capital Coordinator. And just to sort of give you a sense of that, we're, as I'll explain, a very capital-intensive business. And the early founders realized that we really needed to align the sources of our funding with our mission. That's where a lot of social enterprises, or whatever you want to call them, tend to go astray, is that the financing tail starts wagging the dog. And so they have this position. We have various sources of capital. And this is actually one of our most innovative ones. So I just wanted to start. Let me move down here. So this is one of my favorite quotes, and I think it kind of speaks a lot to the mentality of a lot of businesses, and whether they want to think this way or not. But you're put in this position, you're out to do something good, yet the standard model is you're trying to squeeze everyone. A company like ours, if we were run conventionally, we'd be squeezing our suppliers, trying to get the prices down as much as we could, trying to squeeze the people who sell our products, get away with whatever we could to the people who buy them, and then ultimately the financial folks would be squeezing the workers and everyone else. And somehow this is supposed to lead to wonderful outcomes. So the founders of our company said, that's not a good idea. Let's try something very different. But to have it actually be sustainable and really do something different, you have to work at this infrastructure. So Equal Exchange, just very briefly, our business model is we're a fair trade company. We're a worker-owned cooperative, and we're for-profit, but with limits. So just a couple of quick facts, and then we'll move into the CD soon. So we've been around for 25 years. We were the first company. 10,000 Villages gets the honor of being the first company in the U.S. to really do what's considered fair trade today. We were the first company to do it with food, and we're the largest company that only does fair trade. That's all we do. We're also, we're, I believe, the largest worker-owned manufacturing co-op in the U.S. We have over 100 full-fledged worker owners, as we call ourselves, and a few other contract employees. We've been profitable for 21 of the last 22 years. 96, I believe, was the one hiccup there, which we quickly made up for. And we started with coffee, moved into chocolate, tea, nuts, olive oil, and I left off here bananas. And even though we make very little money from bananas, we actually sell more pounds and container loads of bananas now than we do coffee. We also try, we'll sell in supermarkets when the numbers add up, but we also try to make our own markets. So as a co-op, we try to find allies of other organizations with similar missions, and there's one of the tenets of the International cooperative code, which says cooperate with other cooperatives. So we are in just about every co-op food store in the country. We also have a big presence in natural food stores. We opened up our own cafes, just a couple of them. We have we have a whole program. It's about 20% of our sales is actually through faith communities. We're not a religious organization, but we had a lot of overlapping mission when we in our early days, and that's just only grown, and we kind of formalized it, and now we make our products available wholesale to any faith community that they can just either sell our products or serve them, or they can resell them at the full price and use it as a fundraiser. And a similar program with school fundraising groups, also the web, as I said, cafes, our own cafes as well as food service, and what we call our trikes, or free-range cafes, that are our take on food carts. We've grown every single year, and this number ends in 2010. Our early estimates, barring, if present trends continue, we'll be passing that 40 million mark for 2011, and maybe even getting up to 42. And we've also been, like I said, profitable. I guess 93 was the one hiccup there. It took us 3 years to become profitable. Profits have been decent, and the profitability is certainly on a par with our industry. So just very quickly, fair trade, and this is our version of it, which is often a lot stricter than international standards or even some of the licensing groups. We only buy from small farmer cooperatives. So small farmers around the world, we buy from over 40 cooperatives in 21 countries around the world. Some of those represent thousands and thousands of farmers. We always pay above market prices. There's a price floor, which the price we will never pay below, even if the global price goes above that. And when the global price is above it, we will pay a premium on top of that. Long-term contracts is very important for what we're going to be discussing, because we buy the coffee, for instance, 6 months generally before it's harvested. So our model says, hey, we sell a line of Bolivian coffee. A conventional company would just buy from brokers right before they were going to roast it and sell it. What we do is the Bolivian harvest comes in once a year. We contract, we figure out all the Bolivian coffee we're going to need for the entire year, actually purchase it 6 months before it's harvested, and then take possession of our entire year's supply. And our view is that we don't want the farmers paying the carrying costs of those goods. And unroasted coffee you can store for even 2 years in the right conditions. And another key thing to help the farmers, it's one of these hidden things, but it is really critical when you get to know them, is that we offer pre-harvest financing. And what that means is, based on the value of the contract, any of these co-ops can go to root capital or shared interest or other social lenders and get up to 60% of the value of the contract 6 months before they're actually harvesting and delivering the product. And then once and at a very low interest rate. And with this, they can help the farmers have an income throughout the year instead of just selling at a deep discount to brokers or just selling once a year and having a hard time the rest of the year. So what all this means is that for a company that has at its core this fair trade model and a growth model, we are very capital intensive, and we need a lot of we have a lot of inventory. We used to just outsource our roasting. This here is Todd, our head coffee buyer, and he helped set up what you're seeing. Let's see, over here are hoppers where we can put in. Each one of these can hold about 100 pounds of coffee, and we actually have 2 coffee roasters, and we roast in tiny batches, tens of thousands of pounds of coffee a day. And we also have a whole production line off to the side that you can't see here. But anyway, this whole warehouse and facility and these roasters cost millions of dollars. And in our early days, we were not great lending risks. Today, we actually have a lot easier time getting money from banks. Let me just show you a couple other things we put money in. A cafe cost us about $200,000-$300,000 to build out our first Boston area cafe before we even sold our first cup of coffee. That was a lot of money, and it takes a long time to earn that back if you're not trying to exploit people. So, and we're not, and we want them all to be owners in the company as well. So, it again takes a lot of capital. And here, this is actually, I didn't have a photo of our warehouse, but I was just in Peru in August visiting one of our co-op partners, Sepi Cafe, and it looked exactly like our warehouse, where you have each of these sacks has about 130 pounds of unroasted coffee. Each pallet is about each pallet load here, that's about the entire annual output of a small family farm. And they get, depending on what the price of coffee is, somewhere between, I don't know, $2,000 and $4,000 for all their coffee right there. And we have a whole lot of these sacks. They have a whole lot of those sacks, and we're buying them from cooperatives all around the world. But we also have all our other products as well. So where do we get our money from? A bunch of different places. The Class A are this is just sort of a, things shift over time. We had a lot harder time getting people to invest, getting loans from banks, things like that. We've gotten it from Class A or the worker owner shares. Also reinvested our, this is retained earnings over here, the profit. Class B is our private placements that we've done, which have been, as you can see, very successful. And that has been one of our main sources of financing. However, as many of you probably know, you face a whole host of securities regulations that make it difficult to raise the money when you need it, and also limit how you can go about raising it and from whom. So the bar is a lot higher for people who aren't millionaires. You can't do public solicitation, so you end up spending a lot of time going to conferences, talking to financial advisors and other folks, or paying commissions to brokers. We're all doing wonderful work, but this all eats into you raising money for the good work that your company is doing. So we also, this debt, an interesting thing about our debt, it's remained flat even, roughly, even though our needs have gone. So we've been financing our growth through the equity and retained earnings. But we've been shifting this. We still have some conventional bank loans, and we love those bankers dearly for the faith they have in us. However, our heart is in paying dividends and interest to people and institutions that really believe in what we're doing. We think that's the world we want to create, and we value that financing piece as much as the folks going around selling our coffee and stuff. So we've been trying to shift more and more of this debt piece into what we call committed capital, as opposed to indifferent capital. So what happened was one of the limits, let me go back one, with private placements is that you can't have more than 500 individual shareholders. So as we saw that number looming and realized that this wasn't going to be a vehicle that we could offer to everyone, and it wasn't going to fulfill all of our needs, we started looking at other models. And we also felt very frustrated at those limits that, we have some wealthy investors, but we didn't want to make the investment piece, making your capital, your money available to companies you believe in, only something that was open to people with deep pockets. So my predecessor, Alistair Williamson, he's in Portland right now. He's no longer working with Equal Exchange, but we have great admiration and appreciation for the work he did. And one of his insights and brainstorms was to come up with this CD that you're here to learn about. So quickly, it started with a bank, of a very well-known community-oriented bank in the Boston area called Wainwright Bank. Last year they merged with, or they sold to Eastern, which is a mutual, which has the advantage of that is that it's not owned, by shareholders trying to push for quarterly, increased quarterly profits all the time. And Eastern really embraced Wainwright's social mission, and they inherited this program and have agreed to keep it going indefinitely. So that is wonderful. The advantages of this CD. So on one level, it's a standard CD. So if you went to Eastern Bank and wanted to open up a 3-year CD, they have the same $500 minimum. It pays, as my mother says, bupkis, or nothing, nice Yiddish word. But it's the same bupkis that any bank is paying right now. So whatever the conventional CD rate is, that's what they're offering on the Equal Exchange CD. So on that one level, your deposit earns interest. You put it in the bank for 3 years, and the part of it is FDIC insured. So if the bank were to fail, then the deposits up to the legal limits are FDIC insured. So what's different is that you, as the depositor, sign some legal documents that we and the Wainwright folks and some lawyers worked up, and that have been heavily vetted by the FDIC and approved, that allows the bank to pool all of the deposits that are designated as Equal Exchange CDs. The bank then can make up to 90% of those deposits available to Equal Exchange as a line of credit, and the interest rate is a below market rate that much cheaper than we would get if we were trying to get an uncollateralized loan. However, if Equal Exchange were to default on the loan, the bank could keep all, some or all of those deposits. So people are taking on some extra risk. The advantages to Equal Exchange is that it's a collateralized loan, but it's not collateralized by us, so that frees up one business hassle, and we can use our inventory and other assets as collateral for other kind of financing if we need to. It's open to non-accredited investors, so people who you don't have to meet any requirements. It's open to anyone in the country as well. There's no bar on public solicitation, so that's why you don't see anything about our stock offerings on the website or anywhere, but however, you can see information about the Equal Exchange CDs, so we can actually advertise this without fear of regulators showing up at our door, unhappy regulators. And the depositors make a connection to the company, which is really great. They're, how many companies do you say, they're so great that I want to put my money up and get a really modest return at this point, and I'll share some of that risk. So we view those people as very committed. They're the kind of people we're happy to help pay interest to. They know what we're doing. They really want to support it, and we figure they're going to go out and buy our products and tell other people to buy them. And it's also easier for us to manage than a lot of little loans. So we, over the years, we have other promissory notes with different institutions or individuals, and each one of those you have to maintain and spend time and effort tracking, and so on and so forth. We would never do that for $500 loans and the like. So the bank is taking on all of this administrative work, and it makes our life a lot easier. The advantages to the banks, or to the one bank, they're the only one in the country doing it right now, is that the folks who were with Wainwright, who had to explain it to the Eastern folks, as I understand it, the first the Eastern folks were like the Eastern Bank folks when they were, acquiring Wainwright, were very puzzled by this and said, "What the heck is this thing?" And after explaining a bunch of the social aspects and everything else, they decided that, oh, it's a fully collateralized loan. We can understand that, and there's no risk to us. So what's to complain about? That loan spread covers the administration costs, so it's not a burden on them, and it's a way for them to offer a social lending option at no risk to the bank, and they're able to do it in a way that draws in directly the depositors. Otherwise, maybe you like a bank because they do a lot of social lending, but how can you really ever know what your deposit is doing? And you figure anything good they're telling you, maybe they're doing a bunch of other things they don't want you to know about. My apologies to any bankers on the line, but this is the view of a lot of folks on the street. So this is a great way to say, hey, you put your money up, and we will do exactly what we're telling you with this money. And so what one assumes, they're also getting very happy clients who want to do more banking with them. So advantages to the depositor: you can align your values and your money. You're not taking a loss on a similar thing. I mean, with the interest rate so low right now, I just tell people, look, this isn't a great investment strategy. However, if you have some need to put, just stash some cash away, and it's in a conventional bank that you don't feel good about, consider this option. And when people do, they get really happy about it. But they don't have to take a lower interest rate. They are taking on some risk, but in return, and I think that they often feel good about that risk. This is, where we don't realize how much economic risk we're taking when, our 401ks are investing in who knows what. So I think this is a risk that people can really understand. The reality is it's a very small risk because we have so many assets, and if we were, God forbid, to go out of business, we would be able to pay off, if not everyone, the banks get paid off first, and these people count as part of the bankers. So they're first in line. So the real risk is very small, but as we know, risks exist. And in return, they're getting this social return. Hey, my $500 or more is working for small farmers and a worker co-op. So it's an easy option, a very low minimum, no other fees or commissions, and there's no SEC regulations. You don't have to, be a sophisticated investor, and you don't need sophistication to do this. And another element that was really appealing to us was just the idea that we're often told, be a conscious consumer, support causes you like with your spending, or even, get a branded credit card with your alma mater, and the more you spend, the more you'll be, sending off a trickle to some causes you support. And even that we set this up before the financial crisis, we thought that wasn't necessarily the message we wanted to be encouraging people, even though we do want people to spend and buy things very consciously. But this way, we're actually encouraging people to save their money. And in a way, I'd usually describe this as a hybrid between a CD and an investment, in that people understand a CD, but you have to make very clear that they're taking on extra risk. So I just wanted to end with a little picture. This was myself in Peru. I had brought down a small delegation of some investment advisors, some of our investors, and we were hosted by the family farmers who have been with this co-op for over 15 years. We got to stay with them and harvest coffee and really see the impact of the work that we were doing and the partnership that we had built up. So this is the kind of connections we're trying to make when you're drinking your coffee or investing. Your money, buying or selling, that you become as close as possible to understanding the reality and supporting the producers who are doing really the hardest work of any of us to get us the food and drink we need. So I'll actually end it there. It's and open up to questions.
All right. Thank you, Daniel. So you can stop the sharing. That way you can come back to seeing the chat. And then again, we'll remind everybody at the bottom of the call what to look for in terms of getting access to your presentation after the fact. But we've got a number of questions already served up, so we'll start working through those, and we welcome folks to put additional questions in the chat window. So there were a couple of questions about just the basics of equal exchange and how you do financing and how you operate, the kind of foundational information that you gave that then provides context for why and how you do this targeted CD. So let's start with those couple of basic questions. There was a question about your Class B and private placements. Could you explain those categories a bit further?
Sure. I won't go too far into it because maybe that's the topic for another webinar. But and we do not have an offering. This is not a solicitation to sell stock. But it has been something that we have done very successfully over the years. We have about $10.5 million in that we've raised through private placements. You have to hold the stock for a minimum of 5 years. There's no secondary market. And we don't guarantee a dividend, but we have a targeted dividend of roughly 5%, which there have been a couple of years we paid a little less, a couple of years we paid a little more, and the other years we've hit that. And after the 5 years, people are free to redeem their shares or to keep them in the company. And we've gained a lot of experience doing that and really seen a huge upsurge in interest in it and excitement about that in these last couple of years, I think, as people have been very turned off by what they've seen in the conventional conventional companies and the conventional stock market, and what looked like a very, modest rate of return has become a very respectable one. So I'm happy to talk to other people about that individually if they want to, if they have more direct questions around there.
Does Ali have your permission to post your email address?
Absolutely. Yeah, I put it on the slide. So.
Yes, and so folks will see that after the fact, but they can't see it now. So if Ali will post that, that would be great. All right, thank you. And you also, just another basic question, you talked about being a for-profit with limits. And so, again, I want to stick mostly with the targeted CD, but just briefly, can you speak a little bit more to what that means in your daily business operations to be a for-profit with limits?
Yeah, I took out all the fun stuff in my usual presentation, but I guess people really do want to hear it. So some of the limits are that we have a very tight pay ratio. It's actually a 4-to-1 salary ratio between the highest and lowest paid, not highest to average, and that doesn't include benefits or profit sharing. We have absolutely equal profit sharing between every worker owner in the company. Once you've worked here for a year, you buy an ownership share, and then if we have profits that are distributed, in the co-op world it's called patronage, every single person gets the same payout. We, attract investors who aren't looking for the 40%, paydays or quintupling their money, and aren't putting that kind of pressure on us. So that's why that sort of 5% signaling is very important. We want to return a fair return to those people putting up their money and make it a viable alternative. But we sort of explicitly say you're not going to get rich off of this, but we're not going to get rich either. The other, we always guarantee that we're both paying above market prices to the farmers, and we prioritize a lot of our activities to actually investing in the farms, both financially as well as with human capital and helping that co-op in Peru set up their quality control lab, things like that. One of the key things that I'll just quickly mention is that we have what we call a no sellout clause in our bylaws that says that if a company were ever to make an offer, and they do quite frequently, to buy us out, and we could be a star brand in their empire, our bylaws say that we have to pay back any of our loans, our investors, and the stock price is fixed as a fixed rate. That all the net proceeds have to be donated to another organization that works for small farmers. So we wouldn't get to keep any of the money. So it's built into our structure that we will never sell out to Starbucks or Nestle or whoever. And the only people who can vote in the company are the workers. The outside investors do not get a vote. They can only be nominated for the board of directors if the only people who can nominate people are the workers, and 6 of the 9 seats of the board of directors are held by the workers. Although we do have a management structure, executive directors who run the day-to-day operations, but the overall governance is controlled by the workers.
All right. Thank you. That's helpful to just understand a little bit further about some of those pieces you mentioned about who you are as an organization, which of course led you to creating this CD.
And we're also very happy to talk about that, in other contexts.
Sure.
If people are interested in our other business model.
Wonderful. Thank you. Another question, really about why you chose a CD. So, we had somebody say, aren't CDs generally safe and risk-free? Of course, you talked in a couple of places about why this is a somewhat riskier CD. But so could you just go over that again to make sure everybody was clear, the distinction between a CD, which people normally think of as risk-free, and why specifically this one has a little bit more risk? And why you chose a CD. You talked a little bit about that in terms of, lower regulations and your ability to market it and things like that. But could you just make sure everybody's clear on those couple of points?
So, it was initially what led us to even think about alternatives. We'd gotten individual loans from institutions, or in some cases individuals. Again, we had grown to a size where administering those loans is becoming kind of burdensome and not what we were really good at it. The capital raising has been going phenomenally well, but because of the limits, both in terms of the regulations of how we can solicit capital, as well as the total number of investors that we could get and people that could even become part of it, is capped at 500. So we were pushing up against those limits and having to start exclude a lot of people that really wanted to put their money into our business and have it work for us. We didn't come up with the idea of putting money into a CD as collateral for a bank loan. We've actually done that for some other food co-ops, and that's not unheard of, and I think most banks will have a little bit of experience of that. But usually it's sort of a one-off thing. I think in the case where we were helping out a food co-op that wanted to build a new addition, they needed like $200,000, and so they got 4 outfits to put up $50,000 each into a CD to guarantee the loan. And then, the bank felt a lot better about making the loan. So that had happened, but the idea of a rolling one that was open to anyone with really low minimums, as far as we know, on this scale has never been done before. There were elements of it, as I said, the idea of getting people to save instead of spend to support a business they liked, and the 3-year time frame for us were very much, we've been thinking about slow money before anyone came up with the term, and our stock, you have to hold it for a minimum of 5 years. We like to have this kind of long-term planning. 3 years is a nice number for us because it's actually the amount of time it takes when you first plant a coffee tree before it starts bearing fruit. So for those reasons, this appealed to us, and once we looked into it and nobody said you couldn't do it, and we finally got the regulators to sign off and say, okay, as long as you're being upfront and clear with people what the risk is. There's one additional sort of hitch to it, which sometimes people ask about, which is about early redemption. So if you take out a normal bank CD for 3 years and you need your money after 2 years, usually you just pay an interest penalty and you can get your money out. With this, because the money is being used as collateral for the loan, we would only not pay the loan if we were about to go out of business. The bank, in these documents, they make very clear that they retain the right, they have the discretion to accept or refuse a request for early redemption. I think it's only happened once, and they approved it because they see our balance sheet and our finances, and had no worries about the loan. And we generally keep it well below that 90% maximum level, so we leave a cushion in there. So that answers the question. Do you want to go to the next question?
Oh, sorry, I was on mute. Thank you for that, Dan. So we've got a bunch of questions about the specifics of exactly how this CD works. There's a couple broader questions I want to stay with for a moment.
Mm-hmm.
One of them is, do you think this model only works if the lending is designated to one company, in this case Equal Exchange? Or in addition to having a pool of lenders, do you think it could work with a pool of lendees? And in a sense, you're passing through some of these funds to, I think, some of the folks you're working with. But can you speak to that? Does this work only with one,
I think it's certainly easier to have one lendee, but I think with a little creativity, it could certainly be broadened to make it more, and a lot of smaller companies or that aren't selling nationally, for instance, probably would need less money, and so a small pool with these kind of conditions or lack of conditions would be a very useful thing. You might need some sort of a committee that's doing a little more due diligence and keeping an eye on the balances. But I don't think there is really a reason why you couldn't do it. There's some reasons why it would take a little more work. But if that's your goal, I think a model could easily be worked out.
Great, thank you. And did you say that this is the only bank doing this? I know, for example, Alternatives Credit Union and Ithaca links loans via CDs with a bunch of nonprofits. Slightly different model, but speak to that in terms of how unique you feel that this relationship with Wainwright.
The way that, actually, I wasn't aware of that. Actually, I saw a bit in Michael Schumann's new book. And I'm a native Ithacan, so I had a little pride there that my hometown.
And we have the director of our Ithaca BALLE network on the call as well.
Oh, fantastic! Well, hi to Ithaca. So, as I understand it, when we set this up, by a number of measures, it hadn't been done like this. That was certainly the reaction we got from the FDIC and from the bank. And looking around, there might be some variations. I'd have to know more about the alternatives thing. And it sounds like that might be a model that might answer some of the previous question. But as far as we know, like we're claiming that, for a direct put money in, the bank turns around, loans almost all that money to a company that the depositor knows about, and on this kind of open level that's open nationally, is unique. And we would love for it to be replicated. And we are happy to share our experiences where we're doing this webinar, and we've just had a really positive response to it.
Wonderful, thank you. So yes, again, the example I mentioned, which is featured along with your model in Michael Schumann's forthcoming book called Local Dollars and Local Senses, Alternatives Credit Union in Ithaca. I believe that there was something called Share, created and run by E.F. Schumacher, that was up and running for 15 years, but it's been shut down now. I think they didn't believe it was needed anymore. It may be that Van City, which is in British Columbia, is working on something like this. So those are related examples, we believe, but certainly not, not as much actually already happening in the space as we think is really possible. So thank you for speaking to that. Now, getting into some of the CD nitty-gritty pieces, does the bank require a minimum number of depositors?
They didn't, and and I didn't give the current tally of the things. You'd have to ask Alistair Williamson, again, who's in Portland, Oregon, about the initial negotiations, and unfortunately the people at the bank who were there helping set it up are no longer there, so I couldn't get some of that from the very beginning days. I have seen some documents internally where, when it was proposed, Alistair said, well, we might, after a year, or I guess a couple of years, we might have $50,000 or we might have $3 million. So that was kind of the range we were working with. And if it was going to be $50,000, we were going to shut it down because it just wouldn't have been worth it for what we needed. And, so here's where we are. I think we're into our 4th year, and currently, as of September 30th of this year, we finally broke the $1 million mark for deposits. So we have $1,067,000. As far as I know, there wasn't any minimum number of depositors the bank put. I think it was just sort of by mutual agreement. If it had such a poor response, we were all going to pull the plug. But the number has actually grown. I think when I first checked about 2 years ago, we were at about $750,000 in deposits. So, and I know that there have been a number of redemptions. When the initial CDs came up, people didn't renew. So we've had a nice net increase.
Great, thank you. And so that also answers the question we had. How much did you raise through the CD? Did the bank set a maximum limit? So you said they didn't set a minimum limit.
I believe the initial agreement was actually that the loan amount couldn't be more than $1 million. But I think that was before any money was on the table, and I imagine it's up for negotiation if things are going well. So it certainly serves our purpose right now, and it had been sort of flat for a little while, but it's actually gotten to the point where we can start thinking about that again. So initially a loan amount of $1 million, I guess, with the possibility that everything is negotiable.
Got it. So there was no minimum. There was a maximum, theoretically, of $1 million. You've just broken that in year 4, so and things seem to be proceeding well.
Yeah.
Now, what loan total do you think is needed to have the loan spread cover the administrative fees?
So let's see. Currently, so the deal is the bank charges us prime. So currently that's 3.25% and has been for at least this past year. And they are currently offering, I just checked, 0.45% to depositors. I don't know if they keep the spread constant. I think, actually they don't. I think the gap has gotten a little bit wider because I've seen the rate they offer investors or depositors creep down a little bit. But
okay.
Ours will never go below prime. But right now that's, I mean, we couldn't get prime on an uncollateralized loan for $1 million. So it's
great.
It's very good.
Okay.
Anyway,
and
that gives
what
you
is
an
the
idea.
bank? Oh, go ahead.
No. That just gives you an idea. The bank has to work out what spread makes sense for them, but that's the current spread.
Got it. For Wainwright, that is helpful
Eastern.
to understand.
Yeah.
Eastern. Yes. Thank you. And so you mentioned that 90% of the funds are available to Equal Exchange as a line of credit. And there was a question, what does the bank do with the other 10% that's not available? Do you have a sense?
Whatever they want to do with it, I suppose. I think they just wanted a cushion because it's a rolling thing where it's not a thing where you're getting 4 people to put up $50,000 each and the CDs come due at the same time as the loan. And since we're not borrowing the same amount, it's a line of credit. So, as I said, the Bolivian coffee comes in. We need to max out the line. And as the year goes by, we're selling that coffee and at a margin, and we're able to pay off the loan. So we're only paying interest when we need to. I think just to sort of balance out the fact that the amount that we're borrowing is going to vary, and the amount that's available as collateral is going to vary. New money's coming in as old money might be going out. That they just wanted a little cushion. I think there's been one case where either we had hit that 90% or we're about to go above it, or they knew that a CD was about to come due that would push us on the wrong side of that 90%. They just gave us a heads up, and we were able to pay down the line of credit to get us below. So, we wouldn't want this to be our only source of capital and financing, because otherwise those ups and downs would box us in and force us to make decisions that wouldn't necessarily be the best ones. So, but as an additional one, it's been very helpful. I'm sorry, was there another part of that question that I missed?
No, I don't think so.
Okay.
And so there was a question, I think, again, just confirming kind of how this works for an investor perspective. So the loan applicant, so you don't have to collateralize the loan because it's really the equity in the coffee that's collateralized. Yes, that's the collateral. This is a wording I'm taking just from the question.
I think there's a little confusion there. So for us, for Equal Exchange, we're not putting up any collateral. We're not putting up our coffee. We're not putting up our building or equipment, anything else, or receivables. And if we want to get some other kind of financing, we have those assets available to use as collateral. But in this case, for this line of credit, we're not putting up a single thing, just our goodwill. But what we're actually putting up, in a sense, is are these deposits. So the depositor's money is at risk if Equal Exchange were to default on the loans. If the bank were to fail, then the deposits are FDIC insured. If Equal Exchange were to fail or fail to pay the loan, then the deposits are at risk.
Great. Thank you for that clarification. I wasn't quite sure how to serve up that question, but I appreciate you understanding it better than I and jumping in. Let's see here. I'm just looking to see what we haven't gone over yet. Let's see here. We've answered, I think, what percentage Equal Exchange is paying to the bank over what the bank is paying to CD depositors. You talked about that you're paying prime, and they're offering about 0.45%, and that's varied. Let's see here. What rate paying on collateralized loan? I see a new question here. Does it matter if the organization initiating the CD is a 501c3 versus a 501c6? So I think maybe clarifying again your structure would.
Yeah, we are. We are actually a C corp. We are a for-profit corporation, although we operate as a cooperative in the state of Massachusetts. So we are not a nonprofit, even though we have borrowed elements from the nonprofit world into our voluntarily into our structure. So I think it's helpful for us in that we have steady sources of revenue. But as you've pointed out, and some other people have said here, that there have been some other things where, like, and the alternatives credit union one, where they're loaning to nonprofits. But
right, and I think that one, and I don't know if Jan knows more about it than I do, and wants to chime in via the chat window. Again, there's a case study in this forthcoming book, and I'm sure they're happy to answer questions. But my understanding is that might have actually been initiated by the credit union itself, in lending to local nonprofits through a CD, a targeted CD, whereas in this case, it was Equal Exchange as a company or an organization that set up the relationship and found the bank and initiated it that way. And I can imagine it working either way, although I can't really imagine a banking institution initiating that unless it's something like a credit union or a local bank, some kind of more community capital type institution.
Well, and a lot of the credit unions have limits and restrictions on lending to businesses, so that might also shape
sure.
the choices they make. And also, just looking at the chat window, I wanted to give a shout out to La Montanita, one of our favorite cooperative grocers, and I see that they have a loan fund as well. So that's great.
Yes, not exactly a CD per se, but they do have a loan fund that we featured earlier in the series and at our all-day workshop in June. And let's see here. Alternatives Partnership Lending Program allows the nonprofit to collateralize loans made to their clients, as I understand it. Okay, great. So we're all still learning here. We really appreciate your willingness, Dan, and the folks at Equal Exchange to share why you created this targeted CD and how you're using it and how it works. We believe that a lot of BALLE networks could potentially set up a relationship like this to fund themselves, slow money chapters. There could certainly be other businesses in our broader community that might take an approach like this. So we think there's a lot of potential here, and just really appreciate your willingness to share some about the nuts and bolts. So again, as a reminder to everybody, we'll share, Dan has kindly agreed for us to make a PDF version of his presentation available. We also share after these webinars a recording, a link to the audio and visuals integrated that you can watch again. So for everybody who's registered for the webinar, you'll get a link within the next 48 hours from Allie Walker on the BALLE staff. If you have any trouble with those files, let us know. And then watch via our email list and our website, our social media channels, our announcement about our December topic, and then the extension of this series given its popularity into 2012. So we really appreciate everybody joining us today and for the excellent questions. And Dan, in particular for you, we really appreciate your time.
Well, thank you. And, just to sort of the final word, when people go to their banks or if you work in a bank and go to the managers and want to tell them to set something like this up, and they say, I don't know if it could ever work, we're the living example of it. It's been great for both the bank, or us, and the depositors, and we're happy to keep to help out others with our example to help convince other banks that they should be replicating this model.
Well, that is really terrific, and we so much appreciate it. My guess is you will have a number of takers. Mm-hmm. So thank you for sharing en masse through our Community Capital series, and thanks everybody for your time. Go forth and create more targeted CDs, everyone, please. So have a great day.